Hello, everybody, and welcome to Roth IRA Office Hours. I am Rita Soledad Fernandez Paulino. Before I used to feel weird saying my entire name, but now that Bad Bunny went and introduced himself as like his full Benito Martinez, no, Benito Antonio Ocasio Martinez on the Super Bowl twice. Now I'm like, oh, now I'm really gonna tell everybody my full name all the time. So I'm Rita Soledad Fernandez Paulino. You can call me Soledad. You could even call me Sol. And today, this is our February's Roth IRA office hours. I host these calls every second Tuesday of the month, and at this time. So I'm glad that you guys signed up today. I am here to answer as many of your questions as possible. And I also want to let you know that this is going to be uploaded to YouTube. So if you prefer not to be on camera, it's okay. Okay, you do not have to be on camera at all. Okay, so let me go ahead and share my slides with all of you as we still have some people trickling in. There are a total of 10 people that signed up for this Roth IRA office hours. So far, I think tenemos 5 in the room. So like 50% of you guys came in. I will take it. I'm excited to talk dinero with all of you today. Okay, let me share my screen. Nope, that's not how I share my screen. Someone else is coming in. Yay, yay, yay. So we have a good small little group today. When you signed up for Roth IRA office hours, you submitted questions. If you guys have new questions while we're on this call, I want you guys to just feel so comfortable of dropping them in the chat, and to just make sure that you guys all know how to use that chat feature with the question. Can you guys drop an emoji? An emoji in the chat right now as a hello, I'm here, whatever emoji you want, whatever emoji you want. Okay, this is our, okay, we got our emojis coming in. Yay. All right, so like I said, welcome to Roth IRA Office Hours. We are here every second Tuesday of the month. An important disclaimer is this presentation is for educational purposes only. Wealth para Todos LLC does not provide legal, accounting, investment, or tax advice. Please consult qualified professionals for guidance on your specific legal, tax, investment, or accounting obligations. So this is all education. Anything that I share here with you, do not take it as like, oh, this is advice and I should do this exact thing. We have to really have a comprehensive picture of your specific finances and circumstances and all of that. But we're here to learn. Ask as many questions as you want. About me, I am a former public school math teacher turned money and self-care coach. And it has now been, this is going to be my 5th year working as a money and self-care coach. I am the CEO of Wealth para Todos, and I'm just really, really passionate about making sure that everyone has the skills, habits, beliefs, and information to put themselves on track to retire early. That is what I really, really want for a lot of us progressive Black, Indigenous people of color, women, and LGBTQ plus folks. I am the host of the Wealth para Todos podcast. We are coming up to our 1-year anniversary on February 23rd. And I would really, really love to have you as a listener. If you're into podcasts, check out the Wealth para Todos podcast. Other information that I just want to share is like, I'm a queer Mexican American, married to a Black Dominican American, raising a trans daughter and a Black son in Los Angeles, California. And for a long time, I didn't think somebody with my identities could become so financially secure. And what my finances have transformed so much in my 30s, and now I'm like on track to retire early at the age of 47. I'm a homeowner in California. Like things that I once didn't even dream about is like my everyday life now. And I'm passionate about making sure more people have this information. So I'm so excited and happy that you showed up live to these calls. And I really do want to do like my part while I'm alive to make sure I'm spreading this information. Thank you, Wendy. This is about you guys. So when you filled out the form, there were 11 people who signed up, 1 person canceled. So in total, 10 people signed up, and 60% of you already have a Roth IRA 40% of you do not have a Roth IRA. 70% of you have maxed out a Roth IRA before, and that just means that you fill the most that you can fill. And that can vary, right? Like it depends on how much money you make in a year. If the most money earned income you have is $3,000, and the most that you could put into a Roth IRA is 3,000. However, the average income in California is around $74,000. Even if you made $74,000, the maximum that you could contribute to a Roth IRA in 2025 was $7,000 if you're under the age of 50. So, and in 2026, the maximum that you could contribute under the age of 50 is 7,500. So that's what I mean when I say, like, have you ever maxed one out? That means you fully put in there. Yeah, Myrtle, that's what people are talking about when we say maxing out an account. And then I asked you guys, would you like to contribute to a Roth IRA for a partner, for someone else? 40% of you said, I want to, but I don't know how. 20% said yes, and 40% said no. These are the questions that you guys submitted. We have some questions that are just like, first time setup, what do I do next? I opened a Roth IRA via Schwab account. Y ahora qué? I'm brand new to all of this. Pretty much everything feels confusing. We have questions that are a little more specific in terms of traditional versus Roth versus employer retirement accounts. We have questions around strategy and cash flow reality. Should you contribute to your investment account monthly, weekly, or as a lump sum? If you're tight on funds, should you even be contributing at all? And we have this other set of questions around investment basics and vocabulary for beginners. You guys asked, how do mutual funds work? Can you explain trading basics in general? How do you invest the full amount once it's contributed? What type of investments should we choose? And then you also had questions around rollovers, conversions, and transitions between accounts. So today, based on Yay, I'm glad that you're already excited that you're here. Based on the questions that you submitted, I created this presentation for all of you. Now, something you guys should keep in mind is that every Roth IRA office hours is different because I always tailor my presentations based on the questions that people submit. I'll say that there's always like some similarity, but then each one is a little different. So I also want to invite you to sign up for future Roth IRA office hours too, okay? So an overview of what you're going to learn today are the 4 steps to investing in the stock market, how to invest in the stock market with a Roth IRA specifically, some tax strategy basics, rollover and conversion basics, answers to any questions that you also have inside of your, that you drop inside the chat. And also, I'm going to invite you guys to work with me one-on-one and just let you know how I could become your money and self-care coach. Okay, so first things first, to invest in the stock market, you need to do these 4 steps. 1, you have to choose a brokerage firm. 2, you have to choose an account. 3, you have to make contributions into that account. And 4, you have to choose your assets. Those 4 steps it's so simple. It's so simple. And yet it gets a little all confusing because there's a lot of choices. Okay. The way I like to explain investing in the stock market is to think about like you're preparing yourself a meal, right? First, you need to find yourself a kitchen. There are so many different kitchens in the world, right? Like your house, your grandma's house, your suegra's house. Like there's so many different places, and it's the same is true when it comes to investing. There are several brokerage firms that you can choose from to invest in the stock market. The second thing you're going to have to choose is a thing to cook in, right? Like if you're trying to make yourself a meal, and what you use to cook is going to vary based on what you want to make. If you're trying to make pozole, menudo, stew, right? You're going to want a big old pot. That's not what you're going to make a quesadilla in. So it's important that you're aware of like, okay, let me use the right type of tool to invest what I'm trying to make. The same thing is true when it comes to investing. There are different types of accounts that you can choose to invest in, and they each have different rules and different benefits. And so you want to make sure that you're choosing an account to invest in that is aligned with what your goals are for the money. If you're investing for retirement, a Roth IRA is an account that you can choose to invest in. A Roth IRA is different from a traditional IRA. It's different from a 401k, a 403b, a pension. It's different from a taxable brokerage account. It's different from, there's so many accounts, guys. There's so many accounts. Not like so many, like there's more brokerage firms than there are accounts, but we're going to be talking about Roth IRAs. All right. So first step, you choose the brokerage firm. Second step, you select specifically a Roth IRA. Third, you're going to make contributions. And that is the equivalent of gathering all the ingredients to make a certain meal. And then fourth, you have to choose your assets. This is where your money is going to make you money. The most common mistake that people make is they go step one, step two, step three, but then they never choose their assets. And so their money is just sitting there and it's not growing at like giving them the highest rate of return. And so a lot of times people are like, I'm investing, but I'm not making a lot of money. It's usually because you haven't chosen your assets. Okay, so those are the four steps to investing in the stock market. And it could be so simple, but just like when you step into a kitchen, things you have to make so many decisions, you have to narrow down your choices so that you can make yourself a meal. It's the same thing when it comes to investing in the stock market. But I truly believe if you can make a quesadilla, you could quickly, easily invest in a Roth IRA. In fact, I think investing in a Roth IRA, opening a Roth IRA takes about 10 minutes. If you know what you want to invest in, then you could have your Roth IRA maxed out in less than 10 minutes. And especially if you have the cash flow for it. And what? I guess Avia takes longer than that, maybe. Maybe not. I guess these are pretty quick. Okay, so let's talk about brokerage firms. Choosing your kitchen, right? Choosing where your money is going to go. There are 3,000 different brokerage firms to choose from. These are some popular examples. I always like to be really transparent with people. I want you to know, like, I have an investment account with Fidelity, I have an investment account with Vanguard. I also have an investment account with Charles Schwab, and I also have an investment account with E-Trade. Okay, these are some of the most popular ones that you'll hear online. And if you're investing through your job, your brokerage is probably just already selected for you. Okay, when you're opening up a Roth IRA, you have to decide your brokerage firm. If one thing I want you guys to have clarity on is kind of like, okay, which brokerage firm am I going to open up my Roth IRA with if I don't currently have one? And I would say like these top three. Second is you have to choose your account. And like I mentioned a little bit, there are many different accounts that you could use to invest in, and they're going to determine how much you can contribute, right? A Roth IRA in 2026, the maximum that you can contribute is 7,500. In a 401k, oh my God, now I'm blanking out. I want to say the maximum is 23,500, but don't quote me on that. We'd have to look it up. Myrtle says that they want to get to the point where they like to have multiple accounts, and you have so many as validated. Yeah, but just so you guys know, in 2019 when I started, I had a savings account, but I didn't even have a fully funded emergency fund. So we all start somewhere, and it's truly about just taking these little poco actions that are gonna set you up. Now I have my high yield savings account, I have my solo 401k, I have a Roth IRA, I have a taxable brokerage account, I have a joint taxable brokerage account, I have another account with just stocks. Like now I have so many different accounts, but it has also required me to increase my income dramatically. Okay, so here are different retirement accounts. There's also accounts, custodial accounts. By the way, on the Wealth Better Those podcast episode we released last Sunday is about investing for children. So if you want more information of that specifically, make sure you listen to episode 53. It's the latest one. Or maybe it's 52. No, I think it's episode 53. Okay, so you choose an account. Here's more examples of different accounts. So an employer-sponsored retirement account. There's also tax advantage health or education accounts. And then there's also taxable brokerage accounts. Something that we should, I think we have to name is that only 52% of the private industry even has access to employer retirement accounts. And that can impact a lot of communities, right? Because if you're working for a small business, if you like, I think about myself, I started working at the age of 16, but I was always working like kind of like odd jobs, and they didn't offer employer retirement accounts to me. And I could have opened up a Roth IRA and been investing that money towards retirement, and I would have so much money now. But I didn't know anything about investing because my first even glimpse into investing in the stock market came from investing first in my employer retirement account. All right, I'm looking to see if you guys have questions. No questions so far. So, how many retirement accounts should you have? Ideally, I would like for you to have an employer retirement account. That's going to allow you to reduce your taxable income right now if you're investing in a traditional account. Then also have a Roth IRA account because that guarantees tax-free income later. And that's going to save you money in taxes later. And you can withdraw your contributions at any single time. And that's part of the reason why I love a Roth IRA account so much because it's a good way to start learning how to invest in the stock market following those 4 steps. Plus, the money grows tax free and you can pull out your contributions without any penalties. If you pull out money from your employer retirement account, there's going to be a 25% tax penalty. Sometimes, if you're like using the money to go towards buying a house or there's hardship withdrawals, then you can like pull out a certain amount that's not going to come with penalties. However, it's, you have to read the fine print versus a Roth IRA. When my Theo died in October, and I was like wanting to go to the spa and I didn't have all the extra cash flow. I remember telling myself, well, if I wanted to, I could just pull out money from my Roth IRA and I would be able to pull out contributions, no penalty, and that would be able to cover like my spa days. And then the third account is a taxable brokerage account, which is essential if you're trying to retire early before the age of 59 and a half. You can withdraw at any time, but there's not tax benefits. As the money is growing in your taxable brokerage account, you're going to have to pay taxes. And when you pull the money out, you're also going to have to pay taxes. I have a question here. It says, what is your opinion on having all accounts in only one firm? Oh, that's a good question. Um, yeah, I feel like if you like I feel like my husband, he's like that. His employer retirement account is with Fidelity, and then he also has other accounts there too. So his is like that. I know, like for me, I like to have all of my retirement related accounts at one brokerage firm. So I have my um employer retirement account, my Roth IRA, and my taxable brokerage account that's for retirement with Vanguard. I have a taxable brokerage account with Fidelity that is related to like home house maintenance fund and anything like when we're trying to do projects around the house. And then I also have a high yield savings account. Yeah, I have clients who like they prefer to just have one place because it's just an easy login, right? It's one password, everything there. I personally started opening different accounts just because I wanted to become familiar with different brokerage firms. When it comes to the children in my life, I invest in Charles Schwab just because I like having like different logins, right? Like I check my retirement accounts like maybe once a year. I check my investment accounts for the kids again, like maybe once a year. But no, I think my retirement accounts I probably check at least 2 times a year. And then when it comes to like that joint fidelity account of money that like maybe I would use to do house projects, that one I check monthly. And so it's nice that I could just like log on to it and see that one there. Okay. Third step. Okay. So far, just a little recap. We have talked about choosing a brokerage firm, opening a Roth IRA specifically, considering all the different accounts that are out there. And now the third step is that you're going to make your contributions. And if we're talking about, let's see, this is in 2025. Oh, see, so I wonder if in 2026 this is the different number for the contribution limits. They're all gonna vary. And you just want to know those rules. So a lot of times, like a quick little thing that you can do is you can say, like, okay, what is the investment account that you are going to be investing in? And then I just Google like Roth IRA 2026 contribution limits so that I have that number. If your goal is to max out your account every year, you want to make sure that you know that number so that you can increase contributions. Fourth step is you're going to choose your asset. Once your money is in the account, you have to tell it what to do. And there are a lot of different choices that you can make. You can buy individual stocks, shares of a single company like Apple or Tesla or Costco. I feel like a lot of my clients like Costco stock. You could do exchange ETFs, exchange traded funds, and that's just like a basket of stocks that trade like individual stocks. There's index funds that's going to track the performance of a specific market index, so like the S&P 500, which are some like the top performing companies. And then we also have target date funds. These will rebalance and make it very easy for you to invest, especially for retirement. There's something called REITs, funds that invest in real estate markets, and there's also mutual funds. And again, these are a basket of assets. I have a question in the chat and I want to get to it. Wendy says, I have a 403B with my employer, but my contributions are after taxes. So what's the difference between that and a Roth IRA? So Wendy, that might mean that you have a Roth 403B, which means that you're not reducing your taxable income by contributing to that account. The difference between a Roth 403B and a Roth IRA is that a Roth 403B has a higher limit. And yeah, that's it. If you are contributing after taxes, then when you pull that money out later on at retirement, you're not going to have to pay taxes on it. And you just have the ability to contribute more to your Roth 403B, which can work for you. And we're going to get into this when we talk tax strategy. If you're somebody who gets a tax bill every year, then you might want to change your contributions up. Okay. And we'll talk about it again in tax strategy. Thank you for saying that you'll wait. Okay, so here are choosing your assets. I think, guys, that I mean, if you're a first gen wealth builder and you're the first one in your family opening these accounts, all these four steps can be nerve-wracking. But step number one, simple. Like I said, you guys, Fidelity, Vanguard, Charles Schwab. Like if you're just going to narrow down between your top three, let it be one of those. Second choice, opening up an account. Well, everyone here is at Roth IRA office hours, so we're going to focus on a Roth IRA. That's also simple. Third step, you make your contributions. Making sure that you have the money to be investing that you know you don't need for your everyday expenses, that can get challenging. But if you already have the cash flow, whether that be because your current expenses are less than your income and you have that extra money, or maybe you got an inheritance or you want a lawsuit, these are all things that happen with my clients, right? And money has come your way, then it's like, okay, now potentially you have a lump sum that you could put towards to contribute towards your Roth IRA. The fourth step is choosing your assets. And this is where I think it gets it could get a lot more complicated because there's so many different choices around here. But and I know personally that when I opened up my Roth IRA, I had like the money contributed, but I waited, I want to say like at least 2 months before I actually chose my assets because I was so scared. I was so nervous of like, oh, am I going to do this the wrong way? Am I going to put money in and then the money's going to go away? And I was so nervous about that. And one of the things that I looked into was investing in a target date fund and also learning how to create my own four fund portfolio. Okay, so let's talk about this. When you're choosing investments, the things that you want to keep in mind is like, what's a good rate of return on your investments? Historical average of the stock market over the long term, the US stock market has returned about 7 to 10% annually, and that includes after inflation. So that's often used as a benchmark. You want to make sure that what your assets are at least performing at the same level as like the S&P 500 year after year. What that looks like is, let's say like last year we had an 18% rate of return and your rate of return was 7%. I'll be like, oh, let me look into that because my assets are not performing at the US stock market level. Okay, so you'd want to get a little more cute and curious around what you're invested in. Something to keep in mind is the bond market is going to be historically lower, depending on our ages, right? The older we get, we are going to want to be investing in more bonds. So, one reason why you might not have the same rate of return as the S&P 500 is if you're more heavily invested in bonds, because that's going to be less risk, but it's not going to have all the growth. Okay. Then you could also have like this blended portfolio where there's stocks and bonds. And I made this little note of like capitalism sucks. And a lot of us want to do our best to invest ethically. When that is something that you value and you care about, you're going to want to always look into ESG funds. Okay. I just want to give you guys that vocabulary. So the easiest way to choose your assets is to go with a target date fund that has a low expense ratio. Expense ratio is what you pay to invest. And les voy a enseñar. I'm going to show you guys what that looks like at a brokerage firm. Okay. So a target date fund, it's the easiest because you could just set it and forget it. It's going to be a single fund that automatically holds a mix of stocks and bonds, and it's going to adjust as you get closer towards retirement. So if you are 30 years away from retirement, you're going to be invested a lot more in stocks. If you're 5 years away from retirement, you're going to be investing more in bonds. And it rebalances this completely for yourself, completely for you. Um, okay, Isabel said, you mentioned a lawsuit, but doesn't income for contributions have to come from a job? Oh, great question. Yes, Roth IRAs have to come from earned income. But let's say you have earned income from your job, right? And you also have a lawsuit, or you also get this big lump sum of money. If you made $30,000 at your job, then you can still contribute up to the maximum in your Roth IRA. It's not like, and maybe like your salary job is really going to your bills, but and the money that comes from the lawsuit or an inheritance or winning the lottery, all things that have happened with my clients, by the way, that's why I'm saying these examples, then you can just take that money and use that money towards maxing out your Roth IRA. It's not like the government is going to be like, this dollar came from this paycheck, and this paycheck money needs to show a contribution line item to this Roth IRA. It's not going to work like that. They're going to take all your money, they're going to look at all of it. And as long as you have earned income, then you can go ahead and put it in the Roth IRA. Let me know if that answers your question, Isabel. And if you have any other questions. My daughter's name is Isabella. So I'm like, it's hard for me to just say Isabel. Isabel. Okay. So here, a target date fund. What it is, how it works. We talked about that. Why people use it. It is simple. It is just so simple, y'all. And it's a good place to start. Something that's really cool about a Roth IRA is that it's a tax advantage account. So if you today were like, that's it, I'm opening up my Roth IRA, I chose my brokerage firm, I'm opening up the Roth IRA, I'm contributing the money, and I'm just going to choose a target date fund. Cool. Later on, if you learn more stuff, you could sell the money that you put in towards your target date fund and you can buy other things and you're not going to have to pay taxes on it. So a Roth IRA is a great place to just explore what your different choices are. Now, that's different than if you were investing in a taxable brokerage account, which is common when people open up like a Robinhood account. Or what's the other one that's really popular? I don't remember right now. But like, a lot of times when there's apps, there's like you're investing with a like Robinhood had like a really good interface. So that became a very popular place for people to invest. And at first, it was just a taxable brokerage account. Now, Robinhood does have Roth IRA accounts. But let's say you were just investing in a taxable brokerage account and you're like, oh, let me explore investing in the stock market. Anytime you sell something, you get rid of something, you're going to have to pay taxes on it. That is not the case inside of Roth IRA. Okay. Um, let's actually look at doing some of these steps together right now. If I can just exit out of this. Um, yeah, so many tabs. Fidelity. So this is how you would open up an account here. So you would go to open account. and you would say retirement IRA, and then you would say that you want to open a Roth IRA. You would then provide different information. If you're a new Fidelity customer, then you would say that you're not a current Fidelity customer, and you would select here. If you already have an account with Fidelity, then you would just select yes, and it would be you just use your same username and password, and it's really, really quick. Now, in order to open up a Roth IRA at a brokerage firm that you do not currently have a login with, then you're going to make sure that you do the following. You have to confirm your identity. That's going to mean your name, your address, your employment information, your social security number. You'll create a username and a password, and then you'll transfer the money into your account. So you'll link your checking account to your Roth IRA. It's not going to let me like go through all the steps here because it's going to want me to fill in this information, but I just wanted you guys to see like what that looks like. And that is going to take tops 10 minutes. Once you open up the Roth IRA though, the next thing, you're going to open the Roth IRA. So here Fidelity is your brokerage firm. You open specifically a Roth IRA, you contribute money by linking the money into that account. And the fourth thing is that you choose your assets. And since we were talking about target date funds, I'm going to just show you what that would look like. Fidelity doesn't call their target funds, okay, they call them freedom funds. So I just want to look that up. Freedom fund. So here is an example of one of the assets that you could choose. So the way that you purchase your assets is you have to know the ticker symbol. That's all these are ticker symbols. That's how you choose what you purchase. It's similar to like my name is Rita Soledad Fernandez Paulino. My initials are RSFP. That's like the ticker symbol of me, right? And so here you have like a ticker symbol related to whatever you're purchasing, whether it's a stock or a fund. Now, once you look at this asset, you're going to want to look at expense ratios. Remember, I said a target date fund is great as long as it has low expense ratios. 0.66%, wakala, way too high. I do not have any investments with expense ratios greater than 0.15, 0.15. Okay. This is really high. And I just want to show you guys using a mutual fund calculator why that's a big deal. Because you guys might be like, oh my God, Soledad, it's not even 1%, tan dramática. But you guys are going to see that it makes a difference. If you currently have $0, but you plan to be contributing to your Roth IRA every year, and while we're here, let's look up the 2026 Roth IRA contribution limits for 7,500. Okay. So for every year, you're going to be contributing $7,500, and you're going to do this, let's say, for the next, I don't know, 25 years. And your rate of return, well, here we can see this is where it says like average annual return. We always want to go with the greatest number. Okay. So here we have 10 years, 12.01. So we would put that number in here, 12.01. And the expense ratio was 0.66. So we calculate that. Whoop, that's a beautiful number. So 7,500, you will have contributed 7,500 times 25. So you will have contributed a total of 187,500, but thanks to compound interest, that $187,500 will grow to $1 million. Okay, now we're going to find another target date fund, but this target date fund is not going to have such high expenses. See, even here it tells you, hey, that's average, but it's on the higher end. So what we will do, Fidelity, low target date funds. Fidelity Freedom Index Fund specifically. Okay. So before we just looked at Fidelity Freedom, now we're doing Fidelity, Freedom Index. So we'll do the exact same year. So this is one that's saying like you'll need the money by 2040. We'll do this one, but this one's a Freedom Index Fund. Okay. Notice that this one, look at the expense ratios on the low end and it's 0.12. All right, now I also notice that this has a little lower rate of return. But let's just show you the difference between having an expense ratio of 0.66 versus 0.12. Okay, so you're going to look at this number. So right here, the other one, you would pay $113,000 in fees. With an expense ratio of 0.12, you'll only pay $21,000 in fees and you'll end up with an extra $100,000. So there's something that we all remember today is let's make sure that we're checking what our expense ratio is for our assets. It is very common when I'm working with clients. One of the first things that I do once we get into like the investment portion of our work together is we review their portfolio to make sure that they understand what they're investing in. And they're like, that they're not paying too much for their investments, especially if their rate of return is not so good. If we're comparing this one to the other one, I mean, this is 12.01. This one is 11.54. So it's a little different. But even if we change this to be the exact number, 11.54, we still end up with more money when we have a lower expense ratio. So this Nerd Wallet mutual fund calculator, I'm going to just drop it in the chat so that you guys always know that you could use it. All right, let me check the chat. Um, Here you're saying, um, oh, yeah, Myrtle, I agree with that. Your friend who is in finance compliance, definitely stick to bigger firms. So that's something like Fidelity, Vanguard, Charles Schwab's, those are big firms. And also just understanding like a target date fund. It's not, it is so simple, but a low expense ratio target date fund, like it's going to make you more money than a high yield savings account, right? And so just knowing like, oh, that's all I have to do. All I have to do is buy that one target date fund. It will be very, very easy, squeezy, lemon breezy. Lori says, I have this exact investment in my Roth. I should probably sell it. Oh, really? Which one? The one that had the higher expense ratio? Probably. So yeah, or the thing is that you can sell it and then you can just get the one that is cheaper, that's more affordable, right? A lower expense ratio. So if you have this one, upgrade it to one with a lower expense ratio. Okay, back to our slides. Um, Earlier I had gotten a question about tax strategy, but I already forgot what I had started to share. So let me check the chat to see who it was that was asking about tax strategy. Mm, Okay. All right, Wendy, this is where we're gonna talk about tax strategy. Okay, so let me know in the chat if you have additional questions. Okay. So traditional retirement accounts, like a traditional IRA, traditional 401k, solo 401k, they're going to lower your taxable income this year, which can reduce the stress of any current tax bill. Taxes are going to be paid later when you withdraw at retirement. This is best when your income is higher now than you expect it to be later, when cash flow is tight and tax relief matters today, and you're self-employed or in a higher marginal tax bracket. So there was somebody who signed up who was like, I'm a 1099 employee. I get a 1099 every single year. Wanting to invest in a traditional retirement account will be a good way to reduce your taxable income. Okay. Roth IRA retirement accounts, you pay taxes now, but later on, your withdrawals are tax free. You don't reduce your current tax bill right now. You create flexibility in retirement because you're going to have some tax free money. You're not going to have to worry about paying taxes. So it's good to know, like, whatever amount of money that I'm pulling out, like, that is my money now. It is not going to be money that I have to pay taxes and then I have, a certain amount left. This is best when your income is lower or variable right now. You expect your income or tax rates to rise over time, or you want future you to have options. Like I said, my goal is to get everyone I work with to the 10th stage of financial security, where we're working because we want to, not because we have to. And the early retirement is a possibility. And for all of you, ideally, you're going to have those three accounts: the employer retirement account that reduces your taxable brokerage now, your Roth IRA, and your taxable account. Some years, like you may not have all the cash flow to contribute to all three. That also like involves some strategy. But I also believe that there's no limits to how much we can increase our income by. And if we learn the skill of increasing our income, then you'll always have the cash flow to go to those three accounts. Wendy, let me know if this slide helped. If you're thinking how much I should split between traditional and Roth, understand that there's no like correct split. The goal is tax flexibility. The number one question you want to ask yourself, and this again is if you like, let's say you only have $500 to invest on a monthly basis, and you're like, well, which way should I go? Then you would ask yourself this question: do I need tax relief right now? Am I trying to reduce my taxable income right now? Am I getting a bill every year and I'm like, no, I want to pay less? Then let's go traditional account routes. If you're focused on tax freedom later, you could do Roth. Now, it's not either or. You could also split it up. And some people will do 75% traditional IRA, 25% in a Roth. You can always change your split every single year. You're not locked in forever. You could add a Roth IRA account or another Roth account later when your income increases. You can convert traditional money to a Roth also in lower income years. You will have to pay taxes when you do that though. And also you could use both in retirement strategically. All right. For those of you who had questions about rollovers, okay, and wanting like from a previous employer, okay, this thing said, can I still contribute when I don't have a job that doesn't provide a 401k or a 403b? Yes, you can still contribute to a traditional IRA or a Roth IRA. Yesenia. You do like there's an employer retirement account, and then there's this other account. The other account is a Roth IRA account or a traditional IRA account. Once you leave your employer retirement account, once you leave your employer that has the 401k or the 403b, you can't contribute money into that account anymore, into this account. But a Roth IRA or traditional IRA, it stands for individual retirement account because it means it's an individual thing. It's not related to an employer, and that account gets to be yours. Even if you don't have an employer retirement account, you can have a Roth IRA. You could have a traditional IRA. All you need is money, the money to contribute to it. Yesenia, you let me know if that answers your question. Now, Capitalize is a company that will help you roll over previous employer retirement accounts into a rollover IRA. If you have a traditional 401k, it will help you open up a traditional IRA. If you have a Roth 401k, it will help you open up a Roth IRA. And it does it for free. They'll help you locate any old accounts that you have and then help with the paperwork to guide you through it step by step to then move it over. Okay, so I wanted to put that slide in there because that was related to a question you guys had. We still have 15 minutes. So this is where I just want to answer any other questions that are coming up for you guys. And yeah, just answer them now. Yeah, Isabel says that she went through the headache of transferring old accounts to a rollover account all by herself. I did too. All right, question. How often should you check your accounts when you manage things yourself? Ideally, best practice, I would say at least once a year to see if you want to rebalance. When you're going to rebalance, it's going to be based on whether you like the how much stocks you have versus how much bonds you have. If we should primarily focus on the 10-year growth, why do they show the 1, 3, or 5 years? Oh, great question. Let me pull up the slide so we could discuss it. How do I get out of here? Okay, so the reason why we want to use 10 years or even like lifetime, the lifetime which if we click on performance, it'll give us the lifetime version of it. So notice that this Fidelity Freedom Fund, the lifetime of it is 6.14%. And that means that it's performing below the S&P 500, which has a lifetime currently average of 8.23. So the more data you have, the better. The reason why we still see like what happens in 1 year, 3 years, or 5 years is because sometimes you're not investing for a long time. Sometimes you're just choosing to invest for a short amount of time. And so one of the things that you can do is in a taxable brokerage account, you could still choose to invest in this fund, even though that's kind of like more geared towards retirement. And you might be like, okay, my high yield savings account is giving me like 3%. Oh, wow. Like this mutual fund is providing 22.10% in the past year. Maybe if this is money that I want, that I plan to be using, within at least 3 years, it's not money that's so immediate that I'm going to pull from my savings account. Hey, maybe I should put that money in my investment account and let me just get a target date fund. Again, a target date fund is one of the easiest ways that we could all be investing. Now, it is totally possible to invest for even lower rates when you go directly towards an index fund. Let me show you guys that. So this is Freedom Index Fund. And we're going to go with the same year. No. Freedom Index 2040. Oh, oh my. Okay. So what I want you to see is here, our expense ratio is 0.12%. If you wanted to keep more of your money, then you could just look at what this fund is investing in and then just buy those index funds yourself. So for example, here, 48% of this fund is invested in the total market index fund. If we click specifically on that, we get its ticker symbol up here. And look at this. You can invest here for 0% free. And you're not even going to have to pay that 0.12%, right? And so here, if we look over here, the lifetime of this one is 14.54. The expense ratio is 0, then that means that money would grow to $1.7 million, and you wouldn't be losing money to fees. So there's value in learning how to create your own fund index fund portfolio because it'll be cheaper. But then that also means that you're going to have to rebalance it over time. Questions, questions, questions? Oh, okay. Myrtle says that she really likes knowing to just look at what they're investing in and then choosing those same investments yourself. Yeah, so here, this would be the US international stocks. If we click on that one, the expense ratio is 0.01, so it's still a lot cheaper than getting a target date fund with an expense ratio of 0.12. If we look at the bonds, they have US bonds, Siri bonds. They also have long-term treasury bonds. And then they also have international bonds. And so you can look at that. Oh, I'm so glad that this felt less scary. Yeah. And I had you at the kitchen analogy. Yay. That's good. Sometimes I don't know if my analogies are going to work. Like they make sense to me. And I don't even cook. So it's hard for me the fact that I created a cooking analogy, extra proud of myself. All right, guys, any questions? April, go ahead.
Yeah, thank you. It's been super insightful so far. I was wondering, for example, I think I've the amount that I contribute automatically just to try to get into that habit, I don't think has matched the amount that I've set up for transactions to be purchased automatically. So, for example, I have like I think about 10K in an account, but I think only 1,200 has been used to actually purchase something. So one thing I want to try to do this year is to like try to figure out how to use up all of it. So, but I'm not sure is that like one full transaction of that amount or like
Oh, the
increase
lump
what I already
sum or
have?
do it little by
Yeah.
little. Oh, yeah, that's a great question. Okay, so let me tell you guys this. When it comes to lump sums, I feel like, let me not share my screen and just show my face. Okay, when it comes to ideally, Ideally, and in terms of like mathematically, the best thing that we could do is do a lump sum. And so but we don't always have all that cash flow to do that, right? Ideally, your Roth IRA, you know how much you can contribute every year. And I have clients who got into this level of their financial security where they already have their checking account buffer, they already have an emergency fund, they already have sinking funds, and they know how much they need to be investing every year to retire at the age that they want to. So they know, like, I'm going to max out my Roth IRA every year. And what they do is they have a high yield savings account and they're just transferring the savings. And on January 1st, they take the 7,500 or whatever the contribution limit is for that year. And they take that $7,500 and they put it all inside of their Roth IRA and they invest it right away. So lump sums, it's good to have a lump sum. I think where people get all like nervous or scared is they try to time the market. And they're like, well, if I'm gonna, for you, if you have a total of 10,000 and only 1,200 is invested, so then we're looking at like $8,800 that you're gonna put all in, maybe a target date fund, maybe in various index funds, that there may be a party that like, oh, if I buy it at this price and then later on the price, changes, like you're going to feel a little way about that. Let me actually share my screen to show you what that looks like. So if we look at um, S&P 500, Vanguard Index Fund. I don't know the ticker symbols by heart. So this is the S&P 500. And actually, I don't want to look at it here. I want to look at it on Google. Okay. So you see here, let's say that you were going to put all your money in US stocks, specifically the S&P 500, and you decided to purchase your lump sum on January 12th. Well, you paid $645 for it. And then like the price went down on January 20th. And then you see like, oh man, I paid 645 or $44 per share. And now everybody on the 20th is buying shares of this index fund for $627. So then there's these like feelings, but then it goes up and you're like, oh, it's okay. And I think the important thing is to like zoom out because we'll see like, hey, if you had started investing in 2000, this fund would be, you could have purchased it for $126. Are there going to be ups and downs? Yes. Like, markets happen. That was the pandemic when we saw a drop, then we saw an increase, and then we saw it go down. But look, it's trending up. And so instead of thinking about like, oh, let me time the market and try to get in there the best deal, just always tell yourself it's better to just have time inside the market because con tiempo, it should continue to go up. Now that is true when you're in index funds and it's diversified. That's not always going to be true when you're looking at like individual company stocks. For example, if we look at like Coinbase stock, we see that right now it's at $164. If we look at the max, when it first was available to purchase back in 2021, it was sold for $342. And so if you purchased it for $342 and then right now the value is 165, you're gonna be mad. Like you're gonna be mad because you're like, oh, the value of it like is less than 50%. But if you bought it back here in 2022 for $35 and right now it's 164, you're going to be like, okay, like I'm all right with that because the value has gone up. This is, an individual company, right? This is one stock representing one company. So it is a lot more riskier than an index fund. If we look at other stocks, like let's look at Costco stock. So we can see, it's kind of gone down. The value is 975. If we looked at the past month, though, it's kind of gone up. If we look at year to date, there has been an increase. If we look at the past 5 years, this one has had an increase. If we look at maximum, ooh, we imagine buying Costco stock for $9.18 in 1986, the year that I was born, and it now being worth $940 per share. Like, that's cool. That would be really nice. But again, you never know which company is gonna trend up and which one isn't, right? Like Costco, I like Costco. It supports DEI. If we look at Target, and I know personally, I used to shop at Target a lot, but then Target didn't come through when it came to DEI, and we see like the value of their stock has decreased as a result of people boycotting. All right, let me look at the questions. Oh, okay. Myrtle says, can you throw international markets into the mix? Yes, 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 of course. And you should. If we look back at that index fund, oh, I think let me go back to that freedom index fund 2040. Oh, this is like the one that we've been looking at all day, so I'm going to stick to it. If you look at this one, you'll see here that it says non-US equities. That's international stocks. And here is international stocks, and this is an index fund that tracks everything. You'll see that the past 10 years, this one has had a rate of return of 9.75. If we look at the lifetime, it was like 6.66, and the expense ratios are low. And so notice, like, you do want to have a balance between US stocks, international stocks, US bonds, international bonds. If you want to learn more about creating a four fund portfolio, you want to read this book. It's called The Simple Path to Wealth. And that is how I learned about, instead of going from a target date fund to now being able to create my own portfolio using low cost index funds. And so you can learn more about that using this book, The Simple Path to Wealth. Okay, we have 4 minutes. Do I have a podcast on high yield savings account? Yeah, I do. But yeah, I do. In my I think in my sinking funds. Wealth para Todos podcast. Let's see if it comes up. How to use sinking funds to save for joy, rest, and real life. That is going to be the 14th, episode 14. And I talk about like the high yield savings account that I use in there, but that is a resource there. Okay. For the last 3 minutes, if you guys have any other questions, drop them in the chat. But I am just going to share with you guys how I could become your money and self-care coach. Okay. So here, I talked to you about the investment is one payment of $4,111 or four payments of $1,010. What that consists of is 12 45-minute one-on-one coaching calls with me. And then you also have WhatsApp access to me for 4 months. In addition, you have access to my group coaching program, which is called Wealth para Todos Academy, and that's a 12-month program. So for $4,111, I am your coach for 12 months. However, for 4 months, it's like a lot of personal attention. That is where I'm just guiding you through taking a lot of actions to increase your financial security and make sure that you're on track to retire when you want to. Okay. So we have 12 of those calls plus the WhatsApp access. If you're interested in that, you can book a discovery call and you can just learn more information about what it's like. Just schedule one of these calls. You go here, you choose a date that I am available. Um, Oh, if you wanted to, we could talk on Thursday and you'll just fill out like, how did you learn about my one-on-one coaching? What are you looking for in a money and self-care coach? What does financial security look like for you? And what would make paying $4,111 worth it? Like, what would have to happen for you to feel like this is good? I always like that question because that's what I strive to do. I always want all of my clients to be like, this is the best investment that I've ever made. And I mean, a lot of my clients say that. However, a lot of my clients don't want to be talking on my podcast or like sharing their name or their finances publicly. If you want to learn more and just about like the clients who are not shy and do talk about what it's like working with me one-on-one, you can scroll down to my website and do I not have testimonials here? Wow. Wow. I don't even, oh, I have them here. These are some of the clients that I've worked with in the past and what they've said. And you could also listen to some of my clients on the Wealth by Todos podcast too. I've started to invite clients onto the podcast and they share their story. All right, y'all. It was so good talking dinero with all of you. I hope that if you want more one-on-one support, that you book a discovery call and we talk about whether I'm the right fit and whether it is a good investment of your money, your time, and your energy to work with me one-on-one. See you guys later. You guys have a wonderful, wonderful day.
Thank you.
Adios.